Welcome back to the Deep Dive. You've sent us the sources, we've done the mining, and now we're ready to shortcut you straight to the most important insights. Today, we are digging into MapleBear Inc., the technology powerhouse you probably know as CART. We're looking at their Q3 2025 financial results, which came out pre-market back on November 10th.
And our mission today is pretty straightforward. We're going to distill what the executive said, look at the hard numbers, and really figure out what drove that hugely positive market reaction.
Yeah, the stock jumped, what, like 7% pre-market?
Exactly. And more importantly, we need to track what the new CEO is doing strategically. They are making a significant pivot, and this call, it made that crystal clear.
Okay, let's unpack this. So that immediate stock movement happened because the results were just a decisive beat pretty much across the board. They came out before the market opened, so it set a really bullish tone right from the bell. But let's start with the foundational numbers.
The foundational metrics were strong, no doubt. They delivered GAAP EPS of 51 cents.
So that just nudged past the 50-cent consensus.
Right. And revenue was $939 million, which, again, safely beat the street's consensus of around $934 million. That's a robust 10% increase year over year.
A 10% revenue growth is solid for sure, but the profitability story seems to be where they really grabbed Wall Street's attention. Is that right?
Precisely. The adjusted EBITDA came in at $278 million. That's a very, very healthy 22% increase year over year. This is the crucial signal. This is what operating maturity looks like.
So when you say operating leverage, what does that actually mean here?
It's simple, really. Their profits are growing more than twice as fast as their sales. It means they've scaled their infrastructure. And now, for every extra dollar of revenue they bring in, a much bigger chunk of it drops straight to the bottom line.
It proves they're past that hyper-growth, high burn phase.
Exactly. They're an efficient, mature business now.
And that efficiency, it has to be built on strong user engagement. The operational metrics seem to back that up.
Absolutely. Orders were up 14% year over year, hitting 83.4 million. And gross transaction value, or GTV, that's the total value of everything sold on the platform. It grew 10% year over year to 9.17 billion.
It's interesting that orders grew faster than GTV. That suggests people are ordering more often, even if the basket size is, staying about the same.
That's a great observation. It points to higher frequency and stickiness of the customer base.
Okay, so if we break down that nearly $1 billion revenue number, $670 million of that was from transaction revenue. Delivery fees, commissions.
Right, and that leaves $269 million from advertising and other revenue. And that's the high margin segment we really need to watch.
That's the future, isn't it?
It is. And that split defines their future path. The new CEO spent his opening remarks trying to reframe how we should all be thinking about the company. The main message was loud and clear. They are moving beyond being just a marketplace. They want to be seen as an indispensable technology partner for the entire grocery industry.
Right. But even with all that positive sentiment, the market got a slightly mixed signal in the Q4 guidance. Can you walk us through that?
Yeah, so the overall outlook definitely reinforced the beat and raise story. For Q4 GTV, they're projecting between 9.45 and 9.6 billion. That keeps them in that 9 to 11% year over year growth range. And adjusted EBITDA is guided to be between 285 and 295 million. So profitability is still climbing.
Okay, but hold on. If GTV, their core engine, is growing 9 to 11%, how is ad revenue only guided to grow 6 to 9%? Isn't that a pretty big red flag? Advertising is supposed to be their high-margin growth driver.
That is the tension point, and they addressed it head-on. They said the near-term ad pressure is because of macro uncertainty.
So big brands are pulling back on spending for the holidays.
That's the story. Some of their largest partners are tightening their marketing budgets. But, and this is critical, they expressed very strong confidence in getting that advertising revenue back to double-digit growth in 2026.
Where's that confidence come from?
It stems from the strength of their ad tech and the new ad inventory they're creating. And that leads us directly into the three big strategic investment areas.
Right. So after the strong numbers, where is the new CEO actually putting the capital? What are the three pillars he's prioritizing?
He's focusing on affordability, enterprise acceleration, and ads and data innovation. And they're all designed to sort of reinforce each other.
Let's start with affordability. That feels like a necessary defensive move to protect their core user base.
It's the foundation of everything. Management stressed that affordability is the number one reason for customer churn, and it's the main barrier for new customers to even try the service.
And they have data to back up that this is the right move.
Oh, absolutely. They have the data to prove that sacrificing a bit on fees for same as in-store pricing is strategically sound.
So what does that data actually look like in practice?
They pointed out that retailers who offer full price parity, so the prices are the exact same as in the store, are seeing their online business grow 10 percentage points faster than retailers who still mark up prices on the platform.
A 10-point difference. That's huge.
It's massive. And that delta isn't just a number. It fundamentally proves to every retailer that price markups are cannibalizing their own online growth. It makes Cart a consultative partner, not just another vendor.
And we're seeing that work. Heritage grocers and Schnucks are now at full price parity, and they mentioned major retailers are testing pilots in places like Nashville, Chicago, and Dallas.
Precisely. And that partnership theme leads us right into the second pillar, the enterprise platform. The CEO actually said this is the single most underappreciated part of their entire business.
So they're basically telling Wall Street, stop looking at us like a Grubhub, start looking at us like a Salesforce for grocery stores.
That's the strategic shift in a nutshell. They want to empower retailers to win not just on the Cart marketplace, but on their own websites, in their own apps, even inside their physical stores. It makes the retailers stickier.
We saw a big move on that front with Kroger, which is kind of a bellwether for their enterprise strategy.
Absolutely. Kroger expanded the relationship, and this is key. They named Cart as their primary delivery fulfillment partner.
So across all of Kroger's digital properties.
All of them. It's a massive vote of confidence in Cart's enterprise tech stack. It shows that even the biggest players see value in outsourcing this critical fulfillment layer. And they already have scale here, powering over 350 e-commerce storefronts, 240 Carrot ad partners.
But the newest piece of this, and maybe the most exciting, is the AI integration.
Yes. They just launched a whole new suite of products last week using generative and agentic AI. And the key soundbite from the call was, frankly, startling. The CEO said that 100% of the retailers he's spoken to so far are highly interested in partnering on these new AI tools.
100% interest. We need to dig into that. Like, what's the actual application here? It's not just a buzzword, is it?
Not at all. It's about efficiency and intelligence.
Yeah.
The AI is designed to do everything from optimizing picking routes for shoppers inside the store to predicting inventory needs.
And for the customer.
Much better product visibility, really personalized shopping experiences. So for the retailer, it means lower costs and higher conversion rates.
And how do they make money off that 100% interest?
It's a twofold path. First, you have subscription and service fees for the enterprise platform itself. But second, and this is more important for that high-margin ads business.
The data.
The data. These AI tools generate a massive amount of proprietary in-store intelligence. That data feeds directly back into the ads platform, allowing for exponentially better targeting. It's how they guarantee they can hit that 2026 double-digit ad growth target. And this tech is already moving into physical stores with their Caper carts, those smart shopping carts. They're going to be in nearly 20% of Wakefern stores soon.
Which brings us to pillar number 3, ads and data, which has already delivered over $1 billion in revenue in the last 12 months.
And the results for their brand partners are compelling. They see, on average, a 25% boost in sales when they advertise on the platform. The innovation here isn't just on their own site, though. They're aggressively expanding their ad supply by building off-platform partnerships.
Right. They mentioned TikTok and Pinterest?
Yeah, alongside the heavyweights like Google, Meta, and The Trade Desk. These deals let brands use Cart's purchase data for targeting everywhere, making that data incredibly valuable.
And they also highlighted 2 new growth areas, B2B and international.
The B2B opportunity is all about using their existing storefront tech for professional customers. They're rolling out features like invoicing, we'll call delivery.
Like for restaurants.
Exactly. The example they gave was Restaurant Depot, a wholesale supplier. They're now using Storefront Pro to manage their professional customer orders. It's a whole new market for them.
And for international expansion, they're being careful.
Very disciplined. Their strategy is enterprise-led. They're exporting their existing Tech Storefront Pro Caper carts to retailers in places like Europe and Australia. Rather than trying to build a new consumer marketplace from scratch, it keeps expenses down.
Okay, here's where it gets really interesting. Let's shift to the competitive environment and the risk factors investors are always worried about. Starting with basket size, are they seeing customers shift to smaller, quick convenience orders?
Management was very clear on this. Large baskets, so over $75, still represent 75% of the entire online grocery market. And crucially, they are not seeing a decline in those big primary grocery shops. What they're seeing is that competitors are adding incremental small baskets, which are mostly taking the place of a quick trip a customer might have made to the physical store.
So their core remains strong. And how are they measuring success there?
They said they are multiples more effective at converting those small basket users into high-value large basket users than their next closest competitor. It speaks to the quality of their product.
Now we have to address the elephant in the room, Amazon's relentless push into grocery.
Their response was pretty assertive. Management said they're continuing to grow GTV and market share in the top 30 metro markets where they directly overlap with Amazon's biggest rollouts.
So not backing down.
Not at all. They're actually using Amazon's push as a rallying cry to engage their retail partners, to get them to accelerate their own strategies with things like caper carts and price parity. They're leveraging a shared threat.
And speaking of threats, what about regulatory ones? Like the new minimum wage for delivery workers in New York City.
Right. So while that regulation will establish a new minimum earnings standard, which will almost certainly lead to higher consumer fees and maybe fewer orders,
They downplayed the impact.
they put it in context. They said New York represents a relatively small percentage of their total GTV, and they are confident they can navigate the changes without altering their company-level profitability targets.
And they didn't just talk about their confidence, they put some serious capital behind it.
This is the ultimate signal. The board authorized a staggering $1.5 billion increase to their share repurchase program. That brings the total up to $1.65 billion.
Wow, that's a huge commitment.
It's massive. And to get started right away, they're entering into a $250 million accelerated share repurchase program. This puts a very clear, very significant financial floor under the stock. It's management screaming that their stock is undervalued.
Okay, this is not financial advice, but that massive capital return, coupled with this strategic pivot, creates a really interesting backdrop for a directional trade. So let's pitch an outrageous but plausible idea for an investment committee.
The thesis is built entirely on what management is doing, not just saying. That $1.5 billion buyback is the biggest they've ever announced. It's a huge de-risking event. We can acknowledge that the Q4 ad guidance is a temporary macro headwind, but the long-term catalysts like that enterprise AI monetization and international expansion, they're just getting started.
So how do you play that difference between the short-term noise and the long-term structural floor?
You use a two-sided option strategy. First, you go long. You buy long-dated call options, say expiring 12 months out, betting on the stock to get above $45 a share.
So you capture the upside from that 2026 ad growth recovery without tying up a ton of capital.
Exactly. And then at the same time, to address that near-term risk and that floor they've created,
You sell puts.
you sell near-term put spreads. You position them safely below the recent intraday low, around $35. You're basically selling insurance against the stock falling, and you collect a premium for it. You trust that $1.5 billion promise will act as a safety net.
It's a compelling structure. You're using management's own capital allocation confidence to fund the trade.
At the end of the day, the key takeaway here is that Maple Bear is executing a major transition. They're successfully moving from being seen as a last-mile marketplace to being a deeply embedded, AI-enabled tech partner for the whole grocery ecosystem.
So what does this all mean? The question you, the listener, should be mulling over is really about the pace of adoption. We know 100% of retailers they talk to are highly interested in these new enterprise AI solutions that are designed to feed that all-important ads ecosystem. So how quickly will that interest translate into actual monetized software and services? If that adoption curve is steeper than anyone expects, is management's confident 2026 double-digit ad growth target actually conservative? That timing question is the one to track closely. Thanks for diving in with us today, and we hope this knowledge helps you stay well informed.